You know what nobody wants to hear? The reason you're not wealthy has almost nothing to do with the economy, your salary, your education, or bad luck. It has everything to do with your brain actively working against you. And I don't mean that in some vague motivational poster kind of way. I mean it literally. Your brain, specifically the psychological biases hardwired into it through millions of years of evolution, is systematically destroying your ability to build wealth. And unless you understand these biases and build defenses against them, you will stay poor. Not because you're lazy, but because you're human. And being human, financially speaking, is expensive. I've spent 60 years watching intelligent, hardworking people make the same catastrophic financial mistakes over and over. And every single time, the root cause is psychological, not circumstantial. People blame the market, they blame their boss, they blame the government, they blame anything except the real culprit, which is staring back at them in the mirror. The human mind is a wonderful instrument for many things: solving problems, creating art, building relationships, but accumulating wealth. Your mind is almost perfectly designed to fail at that task. Why? Because the instincts that kept your ancestors alive on the African savanna, the instincts to follow the tribe, to avoid loss at all costs, to focus on immediate threats, these same instincts bankrupt you in modern financial markets. Let me be very clear about something. I'm not talking about intelligence. Some of the smartest people I've ever met are broke. I'm talking about temperament. I'm talking about the ability to recognize when your own psychology is leading you off a cliff and having the discipline to stop yourself. Most people can't do this. They're not even aware it's happening. They make decision after decision based on emotional impulses they don't understand. And then they rationalize those decisions with logic that sounds reasonable but is actually nonsense. This is why financial education, the kind taught in schools, is almost useless. You can teach someone how compound interest works. You can teach them about stocks and bonds and diversification, but if you don't teach them about their own psychological vulnerabilities, they'll still make terrible decisions. They'll panic and sell at bottoms. They'll get greedy and buy at tops. They'll follow crowds off cliffs. They'll do everything wrong, even though they know better intellectually, because knowing better and behaving better are two completely different things. Now, there are dozens of psychological biases that affect financial decision making, but 5 of them are so powerful and so common that they account for the majority of wealth destruction I've witnessed. These aren't obscure academic concepts. These are everyday mental traps that cost people hundreds of thousands, sometimes millions of dollars over their lifetimes. And the tragedy is that these biases are completely avoidable if you simply recognize them and build systems to counteract them. So let me walk you through the 5 psychological biases that keep people poor. Not might keep you poor, will keep you poor unless you do something about them. The first bias, and probably the most expensive one, is what I call social proof on steroids. The academics call it herding behavior or social proof bias. But whatever you call it, it's the overwhelming human tendency to do what everyone else is doing, especially in situations of uncertainty. And nothing creates uncertainty quite like money. Here's how it works. Humans are social animals. For millions of years, following the group was the safest strategy. If everyone in your tribe ran away from something, you ran too. You didn't stop to analyze whether the threat was real. You didn't gather data. You just ran because the ones who stopped to think got eaten. This instinct is so deeply embedded in human psychology that it overrides rational thought almost automatically. And in modern financial markets, this instinct destroys wealth on an industrial scale. Let me give you the most obvious example: market bubbles. Every market bubble in history has been driven by social proof. The dot bubble of the late 1990s, the housing bubble of the mid-200s, the cryptocurrency mania of 2021. Every single one followed the same pattern. prices start rising. A few early investors make money, word spreads, more people pile in. Clear as throat, prices rise faster. Now everyone knows someone who got rich, your neighbor, your CO worker, your cousin. And you start feeling like an idiot for not participating. This is the critical moment. You're not buying because you analyzed the investment and determined it was undervalued. You're buying because everyone else is buying and you don't want to be left out. That's pure social proof, and it's about to cost you everything. Because here's what happens next. The late arrivals, people like you who finally capitulated to social pressure, provide the final surge of buying that pushes prices to their peak. And then, because there's no one left to buy, prices start falling slowly at first, then faster. Now social proof works in reverse. Everyone who bought at the top starts panicking. They see others selling, they sell too. Stampede accelerates, and the people who followed the crowd on the way up lose everything on the way down. This pattern has repeated so many times throughout history that it should be predictable. But it's not because each time people convince themselves that this time is different. The circumstances are unique. Old rules don't apply. It's never different. It's always the same human psychology playing out on a new stage. I saw this personally in 1999 and 2000. Everyone, and I mean everyone, was buying internet stocks. People who couldn't operate a computer were investing in companies with no revenue, no profits, no business model. When I asked them why, they'd say things like, well, everyone says this is the future. Or, my friend made $50,000 last month. That's not investment analysis, that's social proof. Warren and I sat out that entire bubble. We were mocked for it. People said we didn't understand technology. They said we were too old, too out of touch. Articles were written about how we'd lost our edge, and we didn't care because we understood something those people didn't. Just because everyone believes something doesn't make it true. Just because everyone is doing something doesn't make it smart. The crowd is often wrong, spectacularly, catastrophically wrong. And following the crowd feels safe right up until the moment it kills you. When the bubble popped, the NASDAQ fell 78%. Trillions of dollars evaporated. People lost their homes, their retirement savings, everything. And it was entirely predictable. Not the exact timing, but the outcome. Because bubbles always pop, always without exception. But social proof is so powerful that people ignore this fact every single time. Now, social proof doesn't just affect your investment decisions. It affects every financial choice you make. The house you buy, the car you drive, the clothes you wear, the vacations you take. Most people don't choose these things based on what they actually want or need. They choose them based on what their peer group has. If everyone in your neighborhood has a $60,000 car, you feel pressure to have one too. If everyone at your office takes expensive vacations, you feel pressured to do the same. This is called keeping up with the Joneses. And it's poverty disguised as normal behavior. Because here's what you don't see. The people you're comparing yourself to are probably broke. They're financing everything. They're living paycheck to paycheck. They're one emergency away from financial collapse. But you don't know that. You only see the surface. The nice car, the big house, the fancy vacation photos, and you assume they can afford it. So you spend money you don't have to impress people you don't like with things you don't need. That's social proof. Destroying your wealth one purchase at a time. So how do you counteract this bias? It's simple but not easy. You have to become psychologically independent. You have to stop caring what other people think. You have to make financial decisions based on your own analysis, your own goals, your own values, not based on what the crowd is doing. This requires enormous mental discipline. Humans are wired to care what others think. It's uncomfortable to be different. It's uncomfortable to be contrarian. It's uncomfortable to sit out a bubble while everyone else is getting rich. But that discomfort is the price of rationality, and rationality is the price of wealth. Warren and I have spent our entire careers being contrarian, not because we're trying to be different, but because we're trying to be rational. And rationality often requires going against the crowd. When everyone is buying, we're usually selling or holding cash. When everyone is panicking and selling, we're usually buying. This isn't complicated. It's just very hard psychologically. You need rules, you need systems, you need a framework that prevents social proof from hijacking your decisions. For us, that framework is simple. We only invest in things we understand. We only buy when the price is attractive relative to value. We don't care what anyone else is doing. We don't care if we look stupid for sitting out a hot trend. We only care about making rational decisions based on facts. If you can develop that mindset, if you can insulate yourself from social proof, you'll be ahead of 90% of investors. Not because you're smarter, because you're more independent. The second bias that destroys wealth is confirmation bias. This is the tendency to seek out information that supports what you already believe and ignore information that contradicts it. This bias affects everyone, myself included. It's almost impossible to completely eliminate, but you can manage it if you're aware of it. Here's how confirmation bias works in financial context. Imagine you buy a stock. Let's say you buy it at $50 per share because you believe it's worth $100. After you buy it, you're psychologically invested. You want to be right. Being wrong feels bad, so unconsciously you start looking for information that confirms you made a good decision. You read articles that are bullish on the stock. You talk to people who agree with you. You interpret ambiguous news in a positive light. And critically, you avoid or dismiss information that suggests you were wrong. If someone mentions negative news about the company, you explain it away. If the stock price falls, you rationalize it as temporary. If analysts downgrade it, you tell yourself they don't understand the business. This is your brain protecting your ego. It doesn't want to admit a mistake. So it filters reality to support the narrative that you were right. The problem is reality doesn't care about your narrative. If you made a bad investment, no amount of confirmation bias will change that fact. All it does is prevent you from seeing the truth until it's too late. I've watched brilliant people ride stocks all the way down to zero because they couldn't admit they were wrong. They kept finding reasons to hold, kept finding evidence that supported their thesis, kept dismissing the mounting evidence that they'd made a mistake, and they lost everything. Not because they weren't smart, because confirmation bias made them stupid. Now, confirmation bias doesn't just affect individual investment decisions. It affects your entire worldview about money. If you believe the economy is going to collapse, you'll seek out doom and gloom predictions that confirm that belief. You'll ignore positive economic data. You'll interpret every piece of news as confirmation that you're right. And you'll make financial decisions based on that biased worldview, probably bad decisions like holding too much cash or gold or avoiding stocks entirely. If you believe you're unlucky with money, you'll notice every financial setback and ignore every financial success. This confirms your belief that you're unlucky, which becomes a self-fulfilling prophecy because you stop trying. If you believe real estate always goes up, or that the government will always bail out banks, or that technology stocks are the future, confirmation bias will prevent you from questioning those beliefs, even when evidence mounts that you're wrong. The solution to confirmation bias is to actively seek out opposing viewpoints. This is incredibly uncomfortable. Nobody likes reading things that contradict their beliefs. It feels threatening, but it's necessary if you want to make rational decisions. Warren and I have always made a point of talking to people who disagree with us. If we're bullish on something, we actively look for people who can explain why we're wrong. We read the bear cases. We try to understand the strongest arguments against our position, not because we enjoy being challenged, because we need to be. Confirmation bias is so strong that unless you deliberately counteract it, it will distort your view. Reality. You need to make it a habit to ask yourself, what would have to be true for me to be wrong about this? Then go look for evidence of those things. Most people do the opposite. They ask, how can I be right about this? Then they find evidence to support that conclusion. That's confirmation bias in action. Here's another technique. Keep a decision journal. Before you make a significant financial decision, write down your reasoning. Not just what you're doing, but why you think it will work. Write down your assumptions. Write down what you expect to happen. Then 6 months or a year later, review what you wrote. Were you right? Were you wrong? If you were wrong, why? What did you miss? This is painful but invaluable. Most people never do this. They make decisions, and if things go wrong, they rewrite history in their minds to make themselves feel better. They tell themselves they knew it was risky, or that circumstances changed, or that bad luck intervened. But if you have a written record, you can't rewrite history. You're forced to confront your actual reasoning and see where confirmation bias led you astray. Over time, this makes you better at recognizing your own biases. It makes you more intellectually honest. And intellectual honesty is rare and valuable in financial markets. The third bias is what academics call recency bias, but I call it the "this is how things always work" delusion. It's the tendency to assume that recent events represent the permanent state of the world. Whatever happened recently will keep happening forever. This bias is extraordinarily expensive because it causes people to extrapolate short-term trends indefinitely into the future, and trends never last indefinitely. Let me give you the most common example: bull markets. Imagine the stock market has been rising for 5 years. Every year, stocks have gone up 15% or 20%. New investors enter the market. They see this pattern and they start believing it's normal. They think stocks always go up 15% per year. They base their financial plans on this assumption. They borrow money to invest more. They quit their jobs to day trade. They tell everyone that stocks are the safest investment because they only go up. This is recency bias. They're taking a 5-year sample and assuming it represents how markets always work. But it doesn't. Markets are cyclical. They go up, then they go down, then they go up again. Sometimes they go sideways for years. Sometimes they crash violently. The 15% annual returns they experienced were not normal. They were an unusually good period, but recency bias makes people forget this. Then the inevitable correction happens. Stocks fall 30% or 40%, and these people are shocked. Shocked. How could this happen? Stocks always go up, except they don't. They just went up recently. And you mistook recent experience for permanent reality. I saw this in 1972 and 1973. People thought the Nifty 50 stocks could never fall. They'd been rising for years. Then they fell 60%, 70%, 80%. I saw it again in 1999 and 2000. People thought internet stocks would rise forever. They didn't. I saw it in 2006 and 2007. People thought real estate prices only went up. Wrong again. And I'll see it again in the next bubble, whatever that turns out to be. Because humans never learn. Recency bias is too powerful. Now, recency bias works in both directions. After a crash, people become convinced that stocks will never recover. They sell at the bottom and refuse to reinvest even as markets rebound. Why? Because their recent experience was losing money. So they extrapolate that into the future and assume they'll keep losing money. This is why market crashes create such perfect buying opportunities. The people with cash and rational thinking can buy from the people paralyzed by recency bias who are convinced the world is ending. Then when markets recover, and they always recover, the rational buyers make fortunes while the recency bias victims miss the entire rally. Recency bias also affects how people think about inflation, interest rates, unemployment, and every other economic variable. If inflation has been low for 10 years, people assume it will stay low forever. Then when it spikes, they're completely unprepared. If interest rates have been falling for 20 years, people assume they'll keep falling or stay low forever. Then when they rise, highly leveraged borrowers get destroyed. This bias makes people terrible at risk management because risk is always lowest in people's minds right after a long period of stability. And that's precisely when risk is often highest in reality. The solution to recency bias is to study history. And I don't mean glancing at a few charts. I mean deeply studying market history going back decades or centuries. When you understand that markets have always been cyclical, that crashes have always been followed by recoveries, that bubbles have always popped, that trends have always reversed, you become immune to recency bias. You stop thinking that this time is different. You start recognizing patterns. You see the cycle for what it is instead of mistaking one phase of the cycle for the permanent state of the world. Warren and I have lived through dozens of market cycles. We've seen euphoria and despair more times than I can count. And because we've seen the pattern repeat so many times, we don't get fooled by recency bias. When everyone is euphoric, we know a correction is coming eventually. When everyone is despairing, we know recovery is coming eventually. We don't know exactly when, but we know the cycle will continue. This perspective is invaluable. It keeps you from making catastrophic decisions based on assuming. The recent past will extend forever. If you're young, you don't have the benefit of personal experience with multiple cycles. But you can study history. Read about past bubbles and crashes. Read about the 1929 crash, the 1970 stagflation, the 1987 crash, the 2000 dot-com bubble, the 2008 financial crisis. Study what happened, how people reacted, what worked and what didn't. This will immunize you against recency bias far better than any amount of recent personal experience, because personal experience is exactly what creates recency bias in the first place. The fourth bias is loss aversion, and it's probably the most psychologically painful one. Loss aversion is the well-documented fact that losses hurt roughly twice as much as equivalent gains feel good. Losing $100 feels much worse than gaining $100 feels good. This asymmetry in how we experience gains and losses has profound effects on financial behavior, almost all of them bad. Loss aversion makes people do irrational things to avoid realizing losses. The most common manifestation is refusing to sell losing investments. Imagine you buy a stock at $100 per share. It falls to $60. You've lost 40% of your investment. But here's the thing. You haven't actually lost anything yet, not officially. As long as you don't sell, the loss is just on paper. It's not real. This is, of course, complete nonsense. The loss is real. You had $100, now you have $60. Whether you sell or not doesn't change that reality. But psychologically, selling makes the loss real. It makes it permanent, and loss aversion makes that unbearably painful. So instead of selling, taking the loss and moving on, people hold. They tell themselves they'll sell when it gets back to their purchase price. They're waiting to break even. This is known as the break-even fallacy, and it's one of the most expensive mental errors investors make, because here's the reality. Thank you, the stock doesn't know or care what price you paid for it. It doesn't know. It owes you a recovery back to $100. It's going to do whatever it's going to do based on the fundamentals of the business and market conditions. If you made a mistake buying it, if the company is deteriorating, if there are better opportunities elsewhere, holding it, waiting to break even is throwing good money after bad. Your money is trapped in a losing position when it could be deployed somewhere productive. But loss aversion makes this irrational behavior feel rational. It feels better to hold a losing position than to realize the loss, even though objectively realizing the loss and reinvesting in something better would be the smart move. I've watched people hold losing positions for years, sometimes decades, waiting to break even. Meanwhile, they've lost not just the money they invested, but the opportunity cost of all the gains they could have made if they'd admitted the mistake, taken the loss, and moved on. Loss aversion also causes people to sell winning investments too early. This is called the disposition effect. People are eager to realize gains because gains feel good, but they're reluctant to realize losses because losses hurt. So they end up with portfolios full of losers. They refuse to sell and empty of winners they sold too quickly. This is precisely backwards. You should be quick to sell losers and slow to sell winners. But loss aversion makes people do the opposite. Now, loss aversion extends beyond just selling decisions. It affects whether people invest at all. Many people avoid stocks entirely because they're afraid of losing money. They keep everything in cash or low-return bonds. They think they're being safe, but they're not. They're guaranteeing a loss to inflation. Cash loses purchasing power every year. If inflation is 3% annually and your cash earns nothing, you're losing 3% per year in real terms. That's a certain loss. Stocks might go down, but over long periods, they go up far more than inflation. So avoiding stocks to avoid the possibility of loss actually guarantees a real loss. But loss aversion makes the certain slow loss of inflation feel less painful than the uncertain but less likely loss in stocks. This is irrational, but it's human nature. The solution to loss aversion is to change how you frame losses. First, understand that losses are inevitable. If you invest, you will have losing positions. Every investor does. Warren and I have had plenty of losing investments. The question is not whether you'll have losses. The question is how you handle them. Good investors cut their losses quickly. They admit mistakes. They move on. Bad investors hold losses hoping for miracles while missing opportunities elsewhere. Second, focus on the opportunity cost of holding losers. Every dollar stuck in a bad investment is a dollar that could be making money somewhere else. When you frame it that way, selling the loser becomes easier. You're not just taking a loss, you're freeing up capital for better opportunities. Third, separate your ego from your investments. Your investment decisions are not a reflection of your worth as a person. You can be smart and still make bad investments. Everyone does. What matters is whether you can admit it and correct course. If you tie your self-worth to being right about every investment, loss aversion will destroy you because admitting a loss will feel like admitting you're a failure. That's nonsense, but it's how many people feel. Finally, use rules to override your emotions. Decide in advance at what point you'll sell a losing position. Maybe it's a 20% loss. Maybe it's when the investment thesis is proven wrong. Whatever the rule, write it down before you invest. Then when the time comes, follow the rule regardless of how you feel. This removes emotion from the decision. You're not choosing to take a loss in the moment. You're following a rule you made when you were thinking clearly. This makes it much easier to overcome loss aversion. The fifth and final bias is overconfidence. This is the tendency to overestimate your own knowledge, skills, and ability to predict the future. And it's absolutely epidemic among investors. Overconfidence manifests in countless ways. People think they can pick stocks better than professionals, even though they have no training or experience. They think they can time the market, even though decades of research show this is nearly impossible. They think they understand businesses after reading a few articles, even though understanding a business deeply requires years of study. They think they're immune to biases, even though everyone is subject to biases. The problem with overconfidence is that it leads to excessive risk-taking. If you think you're better at investing than you actually are, you'll make bigger bets than you should. You'll use leverage, you'll concentrate your portfolio, you'll trade frequently, All of these behaviors work wonderfully when you're right, but when you're wrong, and eventually you will be wrong, they destroy you. Let me give you a statistic that should humble anyone prone to overconfidence. Over 90% of active fund managers, professionals with teams of analysts and decades of experience, underperform simple index funds over long periods. These are smart, educated, hardworking people with every advantage, and they can't beat the market. What makes you think you can? This isn't about intelligence. It's about recognizing the limits of human knowledge and ability. Markets are complex adaptive systems influenced by millions of variables, most of which are unknowable. No one can consistently predict what will happen, not professionals, not amateurs, not anyone. But overconfident investors think they're different. They think they see something others don't. They think they figured out a system and they bet accordingly. Then reality reminds them that they're not as smart as they thought. I've seen this pattern countless times. Smart people, often very successful in other fields, enter investing thinking their intelligence will give them an edge. It doesn't, because investing is not primarily about intelligence. It's about temperament and emotional control. And success in other domains often makes this worse because it reinforces overconfidence. If you're used to being the smartest person in the room, it's very hard to accept that markets don't care how smart you are. Overconfidence also makes people ignore advice. If you think you know better than everyone else, why would you listen to warnings? Why would you consider that you might be wrong? This closes your mind to information that could save you from disaster. The solution to overconfidence is intellectual humility. You need to accept that you don't know as much as you think you do. You need to accept that predicting the future is extremely difficult. You need to accept that you will make mistakes. This doesn't mean you shouldn't invest. It means you should invest with appropriate humility. Diversify because you might be wrong about individual picks. Use index funds because you probably can't beat the market. Avoid leverage because it can destroy you if you're wrong. Keep positions, sizes reasonable so that being wrong doesn't ruin you. Seek out people smarter than you and listen to them. Warren and I have always operated with the assumption that we could be wrong. We don't bet everything on one idea. We don't use leverage. We don't try to time markets. We build margin of safety into everything we do. Not because we're unsure of ourselves in some paralyzing way, but because we're intellectually honest about the limits of our knowledge. One way to combat overconfidence is to track your predictions. Write down what you think will happen and why. Then 6 months or a year later, review your predictions. Were you right? Were you wrong? How often? This is humbling but educational. Most people never do this because they don't want to confront how often they're wrong. But that confrontation is necessary to calibrate your confidence appropriately. Another technique is to ask yourself what your edge is. If you're about to make an investment, ask why you think you know something the market doesn't. Why would you be right when thousands of professional investors are looking at the same information? Sometimes you do have an edge. Local knowledge, specialized expertise, unique insight. But usually, if you're honest, you don't have an edge, you just have an opinion, and opinions aren't worth betting significant money on. Now, let me tie all of this together because understanding these biases individually is not enough. The real danger is when they interact and reinforce each other. Here's a common sequence I've seen destroy countless investors. Social proof draws someone into a hot investment. Everyone's talking about it, so they buy in. Confirmation bias makes them seek out information that supports their decision and ignore warning signs. Recency bias makes them assume the recent strong performance will continue forever. Overconfidence makes them bet more than they should, maybe even use leverage. Then the investment turns against them. Loss aversion makes them hold instead of selling, hoping to break even. The position gets worse. Finally, in desperation, they sell at the absolute bottom, locking in massive losses. This sequence or variations of it happens constantly. And every step is driven by psychological bias, not stupidity, not bad luck. Just normal human psychology operating in an environment where those instincts are destructive. The solution is not to eliminate these biases. You can't. They're hardwired. The solution is to build systems that prevent these biases from controlling your decisions. You need rules, you need checklists, you need accountability, you need simplicity. Let me give you some concrete systems that work. First, have a written investment philosophy. Define what you will and won't invest in. Define how you'll make decisions. Define when you'll sell. Write this down when you're calm and rational, not in the middle of market chaos. Then, when your emotions are screaming at you to do something stupid, you refer back to your philosophy and follow it. Second, automate as much as possible. If you're investing for the long term, set up automatic contributions to index funds. This removes emotion from the process. You're not making decisions based on how you feel. You're following a system. Third, limit information intake. The more you watch financial news, the more opportunities your biases have to hijack your decisions. You don't need minute by minute market updates. You need to check in occasionally and otherwise ignore the noise. Fourth, have an accountability partner. Tell someone your investment rules and ask them to hold you accountable. When you're about to do something stupid, they can remind you of your own rules. This is harder to ignore than self-talk. Fifth, use simple strategies. The more complex your approach, the more opportunities for biases to creep in. Index funds, dollar cost averaging, long-term holding. These boring strategies are bias resistant. Sixth, study your own past mistakes. Keep a journal of every significant financial decision. When things go wrong, and they will, analyze what happened. Which bias got you? How did it manifest? What will you do differently next time? This is painful but invaluable. Most people never do this. They just move on to the next mistake without learning anything. Finally, accept that you're going to fail at all of this. Sometimes perfect rationality is impossible. You will let biases influence you. You will make emotional decisions. You will screw up. That's fine. What matters is catching yourself, correcting course, and doing better next time. The goal is not perfection. The goal is being a little less irrational than the next person. Because in markets, you don't need to be perfectly rational. You just need to be more rational than average. And average is very, very irrational. Let me close with something important. These biases don't just affect investing, they affect every financial decision you make. How much you save, how much you spend, what you buy, how you negotiate, how you think about your career, everything. Social proof makes you buy things to impress others. Confirmation bias makes you justify purchases you shouldn't make. Recency bias makes you assume your current income level will continue forever. Loss aversion makes you stay in bad jobs because leaving feels risky. Overconfidence makes you underestimate how much you need for retirement. These biases are costing you money constantly in ways you probably don't even notice, but they add up over a lifetime. The cumulative cost of these psychological errors can easily be millions of dollars. Think about that. The difference between financial success and financial failure often comes down to which person managed their psychology better, not who was smarter, not who earned more, who controlled their biases. I've known people who earn $50,000 a year and retired wealthy. I've known people who earned $500,000 a year and retired broke. The difference wasn't income, it was behavior. A wealthy person understood their own psychology and built defenses against it. The broke person let their biases run wild. Which one are you going to be? That's not a rhetorical question. You need to decide because your default setting, the path of least resistance, is to let biases control you. That's what happens to most people. They never consciously decide to be irrational. They just never decide to be rational. and inaction is a choice, a very expensive choice. So here's my challenge to you. Pick one of these biases, the one you recognize most in yourself. Maybe it's social proof. Maybe it's loss aversion. Maybe it's overconfidence. Whichever one resonates, focus on that, study it. Think about how it's affected your past decisions. Then build one concrete system to counteract it. Just one. If it's social proof, maybe the system is that you never make a financial decision based on what others are doing. You always have an independent reason. If it's loss aversion, maybe the system is that you review all your positions quarterly and sell anything that no longer meets your investment criteria, regardless of whether you're up or down. If it's overconfidence, maybe the system is that you never put more than 5% of your portfolio in any single investment. Start there. One bias, one system, master that, then move to the next bias. Do this over years and you'll build a fortress around your decision-making that most people never construct. Will you still make mistakes? Of course, but you'll make fewer of them. And in investing, making fewer mistakes is often more valuable than making brilliant moves. Because the biggest returns don't come from being genius. They come from not being stupid. And not being stupid requires understanding and managing your own psychology. That's the real secret to wealth. Not some complex investment strategy, not some insider knowledge, just basic psychological self-awareness and discipline applied consistently over decades. It's simple, but it's not easy. Most people never do it. They spend their lives being jerked around by biases they don't understand, making the same mistakes over and over, and wondering why they never get ahead financially. Don't be most people. Understand your psychology. Build systems to protect yourself from yourself, and let those systems compound over decades while everyone else self-destructs. That's how you build wealth, not through brilliance, through discipline, through self-awareness, through the patient application of rational behavior in a world that rewards irrationality in the short term, but punishes it severely in the long term. The market will test you. It will tempt you with bubbles. It will terrify you with crashes. It will bore you with long periods of mediocre returns. Every one of these is a test of your psychological defenses. Most people fail most of these tests. You don't need to pass all of them. You just need to pass more than average. And if you do that, if you simply manage your psychology better than the next person, wealth will accumulate almost automatically. Not overnight, not spectacularly, but steadily, reliably, inevitably. That's the real psychology behind money. It's not about positive thinking or visualization or any of that nonsense. It's about understanding that your brain is working against you and building systems to counteract that reality. Do that, and getting rich becomes almost boring. Don't do it, and you'll spend your life being a victim of your own mind. The choice is yours.